Money has rules, not the kind written in your country's constitution, and definitely not the kind they teach in school, but rules that have silently shaped wealth for over 300 years. These rules decide who climbs and who stays stuck. But here's the strange part. Most people have never even heard of them. Why does wealth always seem to flow in one direction? The rich stay rich, the poor keep struggling, and the middle class. They run faster, but somehow fall further behind. Why? Because money doesn't move by luck or by conspiracy. It moves by law. Invisible, unspoken laws that have existed since the early 1700s. Let us start with the first law. Gresham's law, bad money drives out good money. 3 centuries ago, coins were made of gold and silver. But rulers got greedy. They started mixing cheaper metals to stretch their supply. People noticed. So what did they do? They hoarded the pure coins and spent the bad ones. Over time, the real money disappeared, and the bad money stayed in circulation. But wait, isn't that ancient history? Not really. The metals may be gone, but the psychology remains. Today, bad money isn't fake metal. It's cheap credit, debt, and printed cash. When central banks flood the system with easy money, they dilute value. And just like before, people hoard the good real assets, gold, property, and circulate the bad, borrowed, inflated dollars. But why does this matter? Because bad money doesn't just replace good money. It replaces good behavior. People stop saving. They start speculating. Patience turns into greed. Stability turns into risk. And who benefits? Always the same group. Those closest to the money printer. Banks, corporations, funds. They get the new dollars first, before prices rise. By the time it trickles down to you through wages or loans, the money's already lost value. That's Gresham's law in the 21st century, your paycheck shrinking. Not because you worked less, but because someone else printed more. Now comes the second invisible rule, the Cantillon effect. It's named after Richard Cantillon, an 18th century economist who understood something everyone else ignored. Money is never neutral. When new money enters an economy, it doesn't raise all boats equally. It flows unevenly, enriching some, eroding others. Why? Because the system decides who gets the money first. Imagine water pouring into a field. The patches closest to the source get soaked first. Further away, the soil stays dry. Today, that source is the financial system. When governments print or central banks stimulate, investors and corporations drink first. Their stocks rise, their assets inflate, their bonuses grow. But for workers and savers, prices rise long before wages catch up. You feel inflation before you ever see the benefit. After 2008, the Federal Reserve added trillions to its balance sheet. The stock market tripled. The top 1% grew richer than ever. But median household income barely moved and housing became unaffordable. Why? Because money doesn't just flow, it chooses its path. And that path always runs through Wall Street before it reaches Main Street. That's the Cantillon effect, 3 centuries old, still quietly determining who wins every economic crisis. Finally, there's a rule that explains why inequality doesn't just happen, it accelerates. Pareto's principle, also known as the 80-20th rule. In every system, 80% of results come from 20% of participants. But over time, that imbalance compounds. 20% becomes 10%. 10% becomes 1%. In 1896, Vilfredo Pareto discovered that 80% of Italy's land was owned by 20% of its people. But why does that same pattern repeat in wealth, power, even attention? Because systems reward understanding, not effort. The minority who know how money truly moves through debt cycles, inflation, and incentives play the game differently. Everyone else works harder. In a game they don't even realize is rigged. The economy doesn't reward sweat, it rewards strategy. And that's why 1% ends up owning more than 99% combined. But here's the thing, these aren't just 3 ancient theories locked in dusty books. They're the invisible gears that still turn the modern economy. Why? Because every financial system, no matter how advanced, still runs on the same human instincts: greed, fear, and control. Gresham's law explains why currencies decay. The Cantillon effect explains why new money always favors the top. And Pareto's principle explains why inequality doesn't shrink, it compounds. Together, they form the invisible architecture of modern finance, a structure so old and efficient that even revolutions, wars, and global crises haven't erased it. But here, as the paradox, these very laws that widen the gap can also help you escape it. How? By flipping their logic. Hold assets that resist devaluation. Position yourself closer to the source of new money, through ownership, investments, or creation, instead of waiting for it to trickle down. Because in this game, the last 2 receive money always pays the price. But the first 2 understand its flow. They write the rules. By the 19th century, these ideas weren't just theories, they became national strategy. Why? Because governments realized that controlling money was more powerful than controlling armies. The Industrial Revolution, global trade, even colonial expansion, All were built on the same formula. Those who controlled the money supply controlled outcomes. Those who received new money first built empires. And those who received it last paid for them. But how did this play out? Take the Bank of England. Founded in 1694, it issued paper notes backed by gold lent to the crown and expanded the money supply through debt. Gresham's law kicked in, paper replaced metal, and real value quietly left the system. Then came the Cantillon effect as policy. Central banks learned to manipulate demand, stimulate economies, and finance governments, all through credit creation. But every expansion had a cost. Those closest to issuance, banks, funds, corporations, grew larger. Savers and wage earners absorbed the inflation. Why does this still matter? Because this same architecture defines global finance today. Every bond issue, bailout, or quantitative easing program follows the same pattern. The first receivers thrive, the rest adapt. Gresham's law operates when excess credit drives out productive capital. Pareto's principle ensures that power concentrates the results. You see it in asset bubbles, unaffordable housing, and widening wealth gaps. Then came a turning point, minus 1971. When the U.S. left the gold standard, money stopped being tied to reality. It became pure credit. Debt and dollars expounded together, feeding each other like twins. And Gresham's law predicted exactly what happened next. Quality money disappeared, quantity took over. Why did inflation rise and savings lose power? Because when value is untethered, speculation becomes the new religion. The Cantillon effect widened the gap even more. Banks and corporations multiplied wealth through leverage, while ordinary people watched prices outpace income. Pareto's principle hardened, the top gained share, the base lost ground. Every crisis since has followed the same rhythm. In 2008, credit markets froze. Central banks printed trillions. Asset prices recovered, but workers waited years for wage growth. Why? Because stimulus doesn't heal inequality, it amplifies it. In 2020, stimulus checks arrived after markets had already soared. By the time households spent them, inflation had quietly erased their value. Different decades, same outcome. Whenever you hear headlines about interest rates, deficits, or quantitative easing, remember, you're watching Gresham, Cantillon, and Pareto at work. The names change. The math doesn't. So how do you survive? Or better yet, win in a system designed to concentrate wealth? Think like the early receivers. Money is a current. It flows fastest, near the source. To stay afloat, you need assets that ride that current, businesses, equities, or productive property. Why not wages? Because wages move after prices rise. The system rewards ownership, not labor. Between 1989 and 2023, the top 1%'s share of U.S. wealth rose from 23% to over 32%. The bottom 50% gained almost nothing. Each recession accelerated the transfer. Pareto's pattern shows up everywhere: in stock markets, where a handful of companies drive returns, in finance, where a few funds manage most assets, and in media, where a few voices dominate attention. Why? Because feedback loops reward scale, not effort. This isn't just an American story, it's a universal equation. Japan's decades of near-zero interest rates enriched corporations and long-term holders. Europe's monetary union quietly transferred wealth toward core economies, emerging markets. They live and die by the strength of the U.S. dollar. These aren't political choices. They're mathematical outcomes. And when trust declines, Gresham's law predicts what always happens. People hoard quality, land, commodities, productive equity, digital stores of value. Every rush into alternatives mirrors the ancient merchant's instinct: hoard the pure coins when debasement begins. Because centuries change, but human behavior doesn't. And the laws of money, they don't care about ideology, only incentives. But here's the trap. The same one policymakers have faced for centuries. To support growth, they must expand. But each expansion lowers the quality of money, triggering a flight to safety. So they try to restore faith by contracting. But contraction slows growth, breeds panic, and forces expansion again. Why does it always end this way? Because confidence, not currency, becomes the final anchor. If you rely on wages and savings, you're the last receiver in that chain. You feel inflation first, and growth last. But if you own productive assets, businesses, equity, property, you stand closer to the source of new money. That difference compounds quietly for decades, defining who climbs and who stagnates. Why does politics feel more polarized than ever? Because these same monetary laws shape behavior. When the majority sense that growth benefits others first, they resist the system. When trust collapses, populism rises. But when policies favor asset holders, governments must borrow to appease everyone else. Each fix adds another layer of credit over the old one, reinforcing the spiral. Governments borrow because voters demand spending. Banks lend because rates are low. Investors chase yield because cash erodes. Workers borrow to live because wages lag. Everyone acts rationally, yet the system still decays. Why? Because it's not built on morality, it's built on math. And math doesn't negotiate. Now the world runs on code instead of coins, but the same invisible laws apply. Central bank digital currencies, CBDCs, extend control to a microscopic level, targeting who receives and when. But who benefits first? Still, the early receivers. Private tokens repeat the pattern. Early insiders hold massive allocations. Late entrants pay higher prices, bad tokens circulate, and quality vanishes into cold wallets. Even data-larization, ISNT, new at S. Just the global version of Gresham's law. Nations diversify away from the dollar into gold, commodities, and alternatives, because the issuer always benefits first. From 2000 to 2023, global debt quadrupled. Debt became the asset. Central banks now hold trillions in bonds, stabilizing markets by owning them. That's not a safety net. That's a live Cantillon effect on a planetary scale. But what happens next? The system can't unwind debt without collapsing collateral values. It can't expand forever without destroying purchasing power. So investors run to scarcity. Gold, real estate, productive equities, and digital assets with capped supply. Each shift follows Gresham's logic. Trade away what loses value for what retains it. To navigate this new terrain, study proximity. Own assets that benefit from early liquidity. Avoid those priced by hope. Diversify across forms of money. Track policy, not promises. History has already written this playbook, we just refuse to read it. In the 17th century, day-base, silver destroyed Spain's empire. In the 18th, Britain's paper money funded its navy and global dominance. In the 20th, fiat money financed wars and welfare. And in the 21st, digital credit, finances, everything. Why does it repeat? Because the surface changes, but the mechanism endures. We now live in a system where value is assigned, not discovered. When new money enters, it rewrites the scoreboard, rewarding debtors over savers, owners over earners. Look ahead 20 years. If inflation averages just 2%, half your savings evaporate in real terms. If asset inflation outpaces wages, ownership gaps widen. Pareto's ratio still holds. A minority controls the majority. Governments will respond with redistribution, wealth taxes, digital tracking, universal credits. But each of those solutions adds complexity, which needs funding, which means more debt. So how do you play this game without being consumed by it? By seeing through the noise. Stop chasing stimulus as salvation. See it as timing. Measure policy by flow, not intent. Build habits aligned with structure. Invest early. Hold scarce assets. Minimize liabilities. Because survival, ISNT, about predicting the storm at S, about positioning your boat before it hits. Prosperity has never been about luck. It's about understanding cause and effect. Gresham warned about quality. Cantillon mapped sequence. Pareto explained concentration. Together, they describe why some climb while others tread water. Money isn't just paper, it's information. Power comes from reading it correctly. Most people study careers, not systems. They trade time for currency without asking who issues it, when, and at what cost. But the moment you start asking, the world starts to make sense. You stop reacting and start planning. The world is entering another monetary experiment. Rising rates, rising debt, falling trust. The same laws will decide who adapts and who collapses. Those who learn them early, adjust first. Those who ignore them, notice too late. You're not outside the system, you're in it. Every payment, every loan, every investment feeds the mechanism. The only question left is, do you understand your position in the flow? Because proximity isn't luck, it's knowledge turned into leverage.